In 1929, investors were told the stock market had entered a new era. In 2000, technology was supposed to make old economic rules obsolete. In 2008, Wall Street insisted the financial system was stronger than ever. And before the 2020 crash, many investors believed modern central banks had finally learned how to control the business cycle. Then, suddenly, the same thing happened. Markets fell. Fortunes disappeared. And millions of people discovered that the rules they thought had changed hadn't. So why does every generation believe its market bubble is different? And why do the same mistakes keep returning under completely new names? By the end of this story, you'll see the repeating pattern behind some of the biggest market crashes in history, from 1929 to the dot-com collapse to 2008. But this isn't really a story about crashes. It's a story about confidence. Because bubbles don't usually begin when people become irrational. They begin when people become convinced that their old definition of risk no longer applies. And that belief has appeared again and again, right before some of the most devastating collapses in financial history. This time is different. In the late 1920s, America was experiencing an extraordinary boom. Factories were producing more. Consumers were buying more. New technologies were spreading rapidly. Radio was transforming communication. Cars were becoming symbols of modern life. And the stock market seemed to be confirming the optimism. Between 1924 and 1929, the Dow Jones Industrial Average rose dramatically. People who had never seriously considered investing began buying stocks. And increasingly, they weren't buying them because companies were generating extraordinary profits. They were buying because they believed someone else would pay even more tomorrow. That distinction mattered, because eventually prices started moving faster than the underlying businesses.
But the most dangerous part wasn't the optimism. It was the explanation. Many investors believed America had entered a permanently higher stage of prosperity. The old fears of financial panics, they believed, belonged to another era. Then, October 1929 arrived. The market crashed. The optimism disappeared. And the belief in a permanently different economic world disappeared with it. But the lesson wasn't remembered as clearly as we might think, because decades later, the same psychological pattern returned. Only this time, the technology was different. The internet was supposed to change everything. By the late 1990s, the internet was becoming the symbol of a new economy. Companies could reach customers across the world. Information could move instantly. Entire industries were being rebuilt. And investors weren't wrong about the technology. That is what made the bubble so dangerous. The internet really did change the world. The mistake was assuming that because the technology was revolutionary, every company associated with it would become extraordinarily valuable. Startups with little revenue could receive enormous valuations. Some businesses were valued primarily on future potential. Traditional measures like earnings suddenly seemed outdated. The question became, how big could this company become? And if someone questioned the valuation, there was always another explanation. The company was early. The market was expanding. Profits would come later. The old rules didn't apply. Then the NASDAQ peaked in March 2000. Over the following years, the technology-heavy index lost roughly 78%
of its value from its peak. Hundreds of internet companies disappeared. But here's the uncomfortable part. The internet wasn't the mistake. The technology was real. The mistake was confusing a real technological revolution with unlimited financial valuations. And that distinction would become even more important 8 years later. Because the next bubble wasn't built around websites. It was built around something people believed was far safer: homes. When safe became the most dangerous word. For years, American housing was treated as one of the safest investments a person could make. And why wouldn't people believe that? You could live in a house. You could rent it. You could borrow against it.
And historically, housing prices had generally risen over long periods. But during the 2000s, something changed. Mortgage lending expanded aggressively. Loans were increasingly packaged into financial products and sold to investors. Risk was distributed throughout the financial system. On paper, this looked sophisticated. Risk could be measured. Models could estimate probabilities. Credit ratings could classify securities. And because the risk was divided among thousands of mortgages, many believed the overall system was safer. But underneath the complexity was a simple assumption. Housing prices would keep rising. If prices kept rising, borrowers could refinance. If a borrower couldn't pay, the property could theoretically be sold. If mortgages were packaged together, investors could diversify their exposure. Everything seemed connected, and therefore, everything seemed protected.